broadcast. It's day 2 and the mood, like I've been telling you for the last few days, is relatively somber. But for the private equity industry, falling markets is always good news because then assets are cheaper to buy. Let's speak with one of the better known private equity faces here in Davos, Stephen Pagliuca of Bain Capital. Thank you very much for joining us, Mr. Pagliuca.
It's great to be here again.
I wanted to know what you make of the volatility we've seen in markets, or in fact, why volatility, the downward spiral these last few weeks?
Well, I think you remembered when we talked last year, I think we encapsulated the discussion by saying that it was a year to proceed with caution because the markets were valued highly. So I think what you're seeing now is a correction, if I had to guess, not a systemic meltdown. I don't see any evidence of bad loans or subprime or some of the things that drove the 2008 crisis. I think it's a correction. The S&P levels, I think, as of today, are about at the median of what they've been for a long period of time. So it's a correction, not a systemic crash, in my opinion. In private equity, we are fortunate in that we can take the long view, and so our company's values don't fluctuate up and down, with the daily market price. And we buy companies to build them, as you know, and transform them for the long term.
Yes.
And we can, at the end, take them public or sell them strategic at the right time for the company and for the shareholders.
Okay. You said that you didn't think this was systemic, but there are many underlying structural fears. There's, of course, China and crude oil and commodity prices that's already playing out. But there does seem to be the buzz here that maybe the U.S. is headed towards a recession as well. I'm just trying to get a sense from you on where you see the global economy headed in 2016, and therefore then, what is the investing strategy? Where do you see growth come in? Where would you be looking to put money into?
Well, there's no question that the China situation of having slower growth has impacted the markets. Now, when you step back, it's still 6.5%, 7% growth. That's still a healthy growth rate compared to many places in the world. And I would argue that 15% was unsustainable for a long period of time. They did a fantastic job. Now, they've always managed their economy very well, and I think they can then make their growth numbers. I was in China about 3 weeks ago, and really it's still bustling. It's an economy that's transitioning, as many have, from a export manufacturing-driven economy to a service economy.
Yes.
And the services side is really growing, and that's really propping up that GDP growth. So I think they're doing the right things. Again, I haven't seen any systemic, financial issues. The banks are as strong as they've ever been. They would in fact say some of this market volatility is because the banks are so capitalized now that they can't buy assets like equities or riskier assets. They get penalized against their cost of capital.
Right. So
there's less liquidity in the market. And with less liquidity, that causes more volatility. So the banks are very stable. They've made energy loans, but in the CEOs I've talked to, they're not to an excess. They're well diversified.
Okay.
Many of them are to big companies. So I do not see a systemic crash. I see a correction. And then for private equity, where are we looking? Well, we look at things like technology, how that's changing the world.
Yes.
So we've looked at financial services companies, payments companies. We did WorldPay. We talked about that 4 or 5 years ago. That's been successfully taken public now. And it's a very powerful company, in payments. We've extended that into other companies in Europe as well, in Italy. So I think that payment space, technology space is a great place to look. United States, healthcare. Certainly healthcare provision systems, technology to make healthcare better, faster, quicker. We're looking at those kinds of things. And also what people I don't think are thinking enough about is with oil prices going down so much. I think from 18 months ago we're down something like $70 a barrel. We're in the 30s now, 30 or 28 even. That's a gigantic dividend for the world.
Yes. And
you multiply $70 per barrel by the amount of barrels that the world consumes, that's a huge number in a dividend. And people will use that to invest, to pay off loans, and that will be really positive because that's a big factor of production in anything in the U.S. as well.
But that hasn't happened as yet, and that is, I think, the most perplexing thing people are talking about, that at these levels of oil prices, consumption should have moved up much faster. Unfortunately, that isn't happening.
Well, I think people are paying down debt. People are saving because people are living longer for retirement. And we had a big crisis to come out of. I think when we talked in 2009 and said we can't solve this thing in 1 or 2 years. It's going to take 6, 7, 8 years, quantitative easing and savers saving. So that's what's happening right now. But that will reverse itself. That money will come back to the economy if these prices stay down low. That's a good thing. Now, if you step back, part of the stock market is a general correction because it has been at the 90th percentile level, not the 50th percentile level in terms of multiples. And secondly, people are saying, gee, the oil thing has two impacts. One, there are loans out to oil companies that could go bad. Two, they're cutting back on capex and direct employees in the oil services. I think over the longer term, those dynamics are going to be outweighed by the fact that the lower cost of oil is good for the world and good for the economy and is going to create a dividend.
Well, that was Bain Capital. We'll take a quick